Hello traders! In this video, we will look at technical indicators and how to use them in your trading. Using technical indicators in trading is a never-ending discussion among traders. Some would say they are useless. Some can imagine trading without them. Although there is oftentimes a common perception that technical indicators are just lagging behind the price, they are still used as a confluence for many price action or fundamental traders. Understanding the technical indicators is something every trader should master, regardless if he or she decides to use them or not. What are the technical indicators? Technical indicators are mathematical calculations based on price or volume. They are used mostly by technical traders. In other words, those who trade by using the technical analysis. Technical indicators provide traders with additional information on what market conditions are right now and the next moves of potential direction. If you are an experienced trader, you most likely know that hundreds of indicators are available in trading platforms these days. You certainly don't need to use all of them. Rather, you should be only to add those working for you or fitting your trading plan to maximize profit potential in your strategy or your trading system. In general, there are two types of indicators: trend following and mean reverting. It is essential to be able to recognize what types of trading environment you are currently in, so you'll be able to appropriate indicators for your situation. Let's now have a look at the most popular indicators. MACD indicator. MACD is the acronym for Moving Average Convergence Divergence. It is trend following technical indicator that shows a difference between two lines, the MACD line and the signal line. The MACD line is calculated by subtracting the 26-day exponential moving average from a 12-day exponential moving average. The signal line is a 9-day exponential moving average of MACD itself. The histogram gets bigger as two lines diverge and disappear when they cross each other. How to trade with MACD indicator? When MACD crosses the signal line, it is perceived as the start of a new trend. Falling below the signal line indicates the signal to sell, and rising above suggests that it is time to buy. MACD divergence. MACD is also one of the preferred indicators to use in spotting a divergence in the market. We talk about MACD divergence when the traded instrument price starts moving in a different direction from MACD. A reversal of the current trend is likely to occur. We can see divergence both on MACD histogram and also the MACD line. As you can notice on a chart right next to me, the price of GBP USD is going higher, but at the same time MACD is showing us lower. That is what we call MACD divergence. Let's have a look at a few more trading examples. Divergence can be spotted on any instrument and any time frame. You can see how many nice and working examples we have on this AUD/JPY 30-minute time frame. Relative Strength Index. RSI stands for Relative Strength Index. It is a momentum oscillator, but it measures the velocity and magnitude of price movements on a scale from 0 to 100. Generally, when the RSI shows reading at 70 and above, we can assume that the instrument is being overbought and the price should go to the downside. Readings at 30 and below suggest that the instrument is oversold and we should see the price going higher. RSI can be used to confirm trends. If a downtrend is occurring, the instrument should be found fluctuating between 10 and 50. If RSI breaks out of that level, it often corresponds with the break of a price as well. The same goes for an uptrend. Expect that the instrument is moving between 50 and 90. RSI divergence. If both RSI and price experience trends but in the opposite direction, divergence can signal a price reversal. Same as with divergence on MACD. One thing which is worth mentioning is the fact that during strong trends, divergence is likely to appear without breaking the trend. RSI is an excellent indicator for calm market environments. When the market is in range, we can find extreme of ranges using overbought and oversold RSI conditions. One thing which is worth mentioning is the fact that during strong trends, divergence is likely to appear without breaking the trend. RSI is an excellent indicator for more calm market environments. When the market is in range, we can fade extremes of ranges using overbought or oversold RSI conditions. But when the market is in a strong trend, RSI can be overbought or oversold for days or weeks before a reversal. Ichimoku cloud. This is one of the more complex indicators with a strong fan base of traders who would swear on this indicator. Frankly, many of them don't need anything else besides the Ichimoku cloud for their trading. Ichimoku cloud is a momentum indicator that determines the directions of the trend and calculates future levels of support and resistance. This makes it unique because it is one of the few indicators which is not lagging behind the price. Kijun Sen, the red line, is also known as the baseline, which is calculated by averaging the lowest low and the highest high for the last 26 periods. Tenkan Sen, the blue line, also known as the conversion line, which is calculated by averaging the lowest low and the highest high for the past 9 periods. Chikou Span, green line, also known as the lagging line. This shows the closing price plotted 26 periods behind. The last component is the Ichimoku cloud itself, also called Senkou Span. Every cloud is made of 2 lines which are used as borders for the cloud. The first line is calculated as Tenkan Sen and Kijun Sen average and plotted 26 periods. The second line is calculated by averaging the lowest low and the highest high for the last 52 periods and plotted 26 periods. Let's look at the GBP CAD 4-hour chart and break down separate parts of the Ichimoku cloud. Kijun Sen. We watch Kijun Sen as our indicator of the general direction of the price. You can think about it similar to the moving average. If the price is above Kijun Sen, it means bullish. If the price is below, it means bearish. Tenkan Sen. Similar to Kijun Sen, but the Tenkan Sen is also indicating market conditions. If Tenkan Sen is moving up or down, the market is trending. If Tenkan Sen is moving horizontally, it signals that the market is ranging. TK cross, crossover of Kijun and Tenkan Sen. This generally means there is a change of direction in the market. And when Tenkan is above Kijun Sen, we are in a bullish market. If the opposite happens, we are in the bearish market. Chikou Span. This one is simple. If Chikou Span is above the price, this is the bullish signal. If it is below, that's bearish. Cloud. Cloud acts as a support and resistance. If you look at the chart, you can see that the price is currently trading above the cloud. This means that if we are going lower, we can use both clouds levels as support areas. From looking at the GBP CAD chart, you can see that we recently had a bullish TK cross. Chikou Span is trading above the price and above the cloud. This seems like a decent buying opportunity, right? As you can see, the price indeed went up, and we could catch this great long trade. Also pay attention to the bearish TK cross and change of the direction of the trend. Moving averages. Moving averages are technical indicators, which probably every trader knows. First, let's cover what a moving average is. Moving average is a lagging indicator that helps trader to smooth out the price and reduce noise in the trading. It is one of the most popular trend following indicators, which is commonly available. Following are different MA types: simple moving average, exponential moving average, weighted moving average, Hall moving average, smooth moving average. These are calculated a little bit differently, but we are not covering it in this video. How to trade a moving average crossover? To be quite honest, trading a moving average crossover is easy as it gets. One of the most popular crosses is the 50 and 200 moving average crossover, called the golden cross or the death cross. Golden cross happens when the 50 moving averages crosses 200 moving averages, and it is below the 200 moving average. Death cross happens when 200 moving average crosses 50 moving average and is above the 50 moving average. Bollinger Bands indicator. John Bollinger, the father of Bollinger Bands, developed this technical indicator in the 1980s. A moving averages calculates Bollinger Bands with the standard deviation above and below the median line. Bollinger Bands use the same principle as RSI and other oscillators with the overbought, oversold arguments. When the price is reaching the upper Bollinger Bands, we can assume that the market is overbought. When we reach the lower Bollinger Band, we can assume that the market is oversold. The median line can be used as a balance and also the target for your trades. Alright traders, this is it for this video. I hope you have enjoyed this video, and if you have any question or you are just interested in something or you are just struggling in something, just let your comment down below. Please don't forget to subscribe our YouTube channel, and I wish you steady study and see you next time.